Good afternoon, everybody. Welcome back to the Schwab Coaching Channel on this inaugural National Investing Day. Really glad to have you all joining me, and thank you so much for being here. Want to have you say hi to my friend Mike Fairborn in the chat today. He's going to monitor questions and comments that I'm unable to get to here live during our discussion, but feel free to post in there for the entirety of our segment. We typically go about 45 minutes here, and I will surely try to answer questions that you post in there, everybody, but anything I'm unable to get to, Mike is there to pick up the slack, so to speak. So glad to have Mike on board, and if you're not already doing so, everybody take a minute and follow Mike and me in the world of X. We're available each at Mike Fairborn CS, and I am, of course, at Kevin Horner CS. It's a good way to get with us outside of the classes that we provide here on the YouTube coaching channel. So we'd love to have your follow there, everybody. All right, let's cover some very basic disclosure detail, and then we will get into today's discussion. Remember that our conversations on the channel here, they're entirely informational and educational. We do not make recommendations here. We do try to provide you with some ideas, concepts, strategies investors and traders may choose to employ, but the real takeaway is that that's what we're all about, education here on the YouTube coaching channel. We will be working today in our in placing some actual trades, some example trades. We'll be doing that in our Thinkorswim desktop application, paper money version. Essentially, it's going to be essentially what you'll be seeing and finding in your own version of Thinkorswim, of course. But some of the detail that's available in paper money is not always what's available in live money, and some of those details will be kind of what we run into today in use of our scan tool to a certain extent. So just be aware that in certain cases, you may want to be working with the live platform, particularly when it comes to scanning specifically. All right, so this is a series that covers a number of key components for investors who are just starting to scratch the surface of their investing tenure, their lifetime of investing, we hope. And there's a number of these things that we cover in this particular series. So if today's conversation doesn't hit the nail on the head for you, please know that we have a series of archived videos of this very class that goes back all the way to 2024 beginning, and you can find those right here on the channel. In fact, I've got one, a link set up and ready to go. And one of the, I'm going to post this in here into the chat, everybody, so you've got it. And you can all reference this. This might be a good thing to bookmark for yourself if you're, like I said, just getting familiar. Maybe you want to see this series over the course of the next few weeks and months. This is a great way to do it because our versions, our archived classes end up on that playlist here shortly after completion. So would love to have you following us there. Hey, Alan, great to have you here for the first time. We love new viewers, of course. Today, the agenda is going to be a little different than what's discussed here. Really, we're going to work through some fairly basic concepts. We're going to look at what is a top-down method as it relates to investing in the market. And then we're going to take a look at our example portfolio via the Monitor tab in Thinkorswim. And further, we're going to then place some new example trades to apply to our long-term view of maybe how an investor wants to consider allocating funds to the U.S. domestic markets. So it's a lot to cover, obviously, but it's going to be a good show, I believe. So let's get right to it for y'all, okay? So one of the things that we need to know about overall markets is we have to be prepared for news and what news can do for us. And for those of you who are coming to these conversations by virtue of what's been going on the last, say, month to 2 months as we discuss a slew of narrative details headlined with tariffs as an example. But market news has a huge impact on the drive in the market on a short-term basis. Not necessarily a long-term basis, because one of the things we've learned is that in the long run, the market has that upward trajectory, an upward bias. Doesn't mean it goes up in all windows of time, of course, but it does mean that over the long haul, the long run viewpoint shows that markets move higher. And that's just a natural component of broad investing markets. Now, in the short term, things like Fed funds rate decisions by the The U.S. Fed can absolutely have an impact on things, as can reports on data tied to the health of the economy. Yesterday, for example, we received detail on the U.S. GDP figure that indicated contraction in the first quarter, and that was something that put a bit of a shock into the market, but it was a short-lived shock because what we saw was a very weak open followed by a strong close that has to this point today been carried forward again bullishly. So market news, very important aspect for all that we want to do. But if your approach is one of long-term investing, thinking about this balance you're maybe working with and thinking about it not from a standpoint of how is this balance going to look at the end of the year or how's it going to look late next year, but rather how is this going to look in 2040 or 2045, 20 years down the road when this balance is then going to be needed. Many of us are investing in retirement assets with a stated goal that I'm going to get to that balance in 15 or 20 years. And it's that long-term approach that often should give the investor the confidence and comfort to just simply do what they do best, stay the course, continue to provide funds to that portfolio by simply working roles, working jobs, and making sure that we are funding retirement assets as consistently as we can, and further getting that money into the market, because one key component that is very easily missed by new investors is the idea that you just keep going, meaning it is all about the amount of time that you have your money invested, not trying to pinpoint when it makes the most sense to you to put that money to work. And that's because, again, over that long haul, the bias is to the upside. Therefore, by staying the course and continuing to invest that money and putting it into the market, you're going to see that benefit over the long haul, not something that you see in any given window or a specified window of time, but rather 20 years down the road, hopefully, when we get to need those funds. So when we talk about the market, we talk about the major indices, and this class is no different. We talk about the S&P 500 quite a bit in many of the courses that we provide here from an education standpoint, because it's the 500 largest companies in the U.S. market, and it's a real broad indicator of the health of the U.S. market as well. Whereas the Dow Jones, which is something I think many of us fall prey to, we think of the Dow as being the number one indice, but it's really only 30 securities. It doesn't provide nearly the amount of distribution amongst the various categories and groups in the marketplace. So it is certainly the oldest, most well-known index, but by some measurements, and certainly according to many, many traders and investors, it's just not as broad a reflection of what's going on in the economy. We also have the NASDAQ 100, or the composite view, rather. The NASDAQ composite incorporates all 3,000 of the NASDAQ securities, but there's, in terms of following and keeping a close eye on things, many traders would suggest you want to monitor the NASDAQ 100, the top largest 100 stocks in the NASDAQ composite index. And then finally, we have the Russell 2000, a small cap grouping, looking at the 2,000 smallest stocks that are part of the Russell 3000 index. As you can see here, it's a cap weighted, but this is built and comprised of really substantially smaller companies by and large, and there will often be changes to that grouping frequently, because small cap companies have a tendency to not make it, unfortunately, in the business models, and in certain cycles in particular, they go through rough patches. And so it can be a real instructive view to check out what's happening with the Russell 2000 as an index, because it can speak, once again, to the overall health of the U.S. markets. Now, when I mentioned off the jump today, we were talking top-down methodology. This is pretty much what we're talking about, right? It's the idea that we like to spread investment dollars over a multitude of groups and categories, and it starts with the broad indices. So when you think broad indices, we think large cap and small cap, and we also think about an international component when we're talking about investing broadly. Now, within those within those broad sectors, those broad categories, that being the broad big ones, right? Like I said, the the S&P 500 and the NASDAQ and international components, we then work our way down the 11 sectors of the U.S. domestic markets, which incorporate staples and technology, energy, and financials, and so on. And it is an investor's goal commonly to get that money spread into those groups consistent with something known as the MSCI view of the overall international markets. Essentially, what this is doing is it's trying to provide a model against which traders and investors can allocate funds in an appropriate manner. And what I'm referring to is if you were to look at the common breakdown, and by the way, this is something we have looked at in this class previously. In fact, according to the playlist that I'd loaded into the chat for you all, we go back to, I think it's 2 weeks ago, the April 17th conversation titled Get to Know the Portfolio Checkup Tool. This is where I dive deeper into the components of the MSCI, the allocation dollars specific, to basically match up a portfolio to the allocation of the MSCI viewpoint. So you can check that one out. Again, April 17, Get to Know the Portfolio Checkup Tool. I think that one would kind of blow this conversation out a little bit more if that's what you're looking for. Now, beyond sectors, of course, we move into industries, subgroupings within those 11 sectors, and then finally, ultimately, individual stocks. Now, you as investors can choose to take this process however you would like. Some investors like the idea of, instead of incorporating stocks, they might stop at the industry and sector groupings and utilize exchange traded funds or mutual funds to devote money to those groups of the market, choosing to further diversify by utilizing asset groups that are investing in a multitude of stocks on their behalf. That's what an exchange traded fund is, what a mutual fund is, of course, right? So the idea there is make it really easy on the end user. The individual investor gets the opportunity to say, I need exposure to this sector or this industry group. And instead of me picking the number one or number two stock in that space, I'm going to ask the investment manager, the fund manager of that fund, to do that homework and all that legwork for me. And I'm just simply going to devote and expose money within my portfolio to that group. So you can certainly go that route. Now, today, in this particular approach, we are going to be looking at individual stocks that are going to match up or give us that exposure. Okay, so let's bring up Thinkorswim. Here we go. And let's see, we got an S&P 500 chart on here. Let's go to our monitor tab, everybody. And we're going to talk a little bit about what we've already done in this breakdown in our example portfolio. So what you're seeing here, everybody, excuse me, what you're seeing is that I have gone through a process of telling the platform I want to see my example positions broken down by sector. And I did that by going to this actions menu and down to group symbols by and selecting sector. Okay. Now, if I didn't want to do that, I could change that to none, or maybe you want to see how it looks based on market capitalization. You'll notice they all fall under large cap. And we're going to talk a little bit about why, or how rather, an investor might make that a little bit, might choose rather to devote money to small caps as well. We'll look at that here in a minute, but let me see if I can help you out here, Eva. I'm going to try to get up to my setup link. Let's go up to application settings and look and feel. We've got font size as large. Yeah, let's kick this up to larger. I can't go too much larger though, because I start to lose some real estate. There we go. So it makes a bit of an adjustment for you, Eva. I hope that helps. I know that it's not easy, of course, but one of the best things about this platform, absolutely, is that you can get it built the way you want, from size to fonts and so on and so forth. So make sure that your individual platforms are actually looking how you want them. So hope that helped out, Eva. We're going to look at these individual positions briefly. I'm going to regroup the categories here off of capitalization back to my sectors. So what do we have? We have healthcare, we've got financials, we've got technology, and then we've got others under First Energy falling under others there. So just a brief, quick look. I've got about 5,600. First Energy's got a very small position, $2,000, 4,800 there in financials, 3,200 in healthcare. We're going to add to some new groups in this space, or rather in the example portfolio today. But I wanted to look at these just quickly to see if there's anything we need to do. Now, I'll remind you, everybody, chances are we don't need to do much of anything, because this portfolio, the goal here was simply to build and put that money to work. We were just simply taking advantage of the weaker market we've experienced to get a little start on things. So I think we take a look at Lilly here briefly. A couple of choices for you, by the way. If this is maybe one of the first times you've seen Think or Swim, you can always just right click on the row for your equity, and you can say, hey, send this somewhere else. I want to see more info on this, or I want to go to another location, right? You can also incorporate, let's see here, what I like to, we call it the send to here. And so all of my tools, everybody, are built with the purple icon. And so by putting the purple icon in here now, I can just click the 5, and Lilly is going to be populating my chart real quick. So I'm going to put that one in, and yeah, I see that, Mark. Lilly did not have a fine reaction to the earnings, so there's a position that's not working fantastically today. As you can see, it's been thrown back to its 20-day moving average. That's the orange line here. And some traders might tell you, hey, that's a spot where they might look to add following a weak earnings report. Some others might say things like, that's nice that it's cheaper now. I might be able to buy it near $800 a share. But at the same time, they might say, you know what, let me let the dust settle first. Let's make sure that the selling isn't going to get bigger than a 10% move today. So I think it may make sense for some to let this settle out. Now, your alternative there, of course, is to say, yeah, I'm not worried about that. Could I be buying it cheaper? Sure, but I'm looking for reasons to add to a position, and a move 10% on earnings to the negative side gives some investors a little bit of an opportunity. They look at that and they say, I'd be fine to buy that up. Now, from our technical analysis portions of this segment, where we've spoken about what could happen, the possibility does exist that the stock moves through the lows we made back here, and maybe it has to revisit the lows we created on the broad market weakness, the selling in early April. Perhaps that's the case, but it's obviously at the trader or investor's view as to whether they decide to add to a position like Lilly here today or be patient. For our purposes, yeah, we'll sit tight for now. We'll see how this looks. We'll give it at least another week, and the possibility exists that we might be able to add at a lower rate. Let's jump back to the monitor tab. And by the way, everybody, the only reason I said add is simply because we've got a small dollar of allocation relative to what else we have in the market. You can see our technology group doing very well, and the balance is greater at 5,600 versus healthcare at 32. So if we're trying to simply get ourselves into a balanced approach, for example, which is something some investors may choose, then you might look at that and say, well, yeah, we're going to look to add to Lilly based on that move to the downside. Let's take a peek at Pfizer. It's moving nicely, up 8% for us. Quick peek at the chart. They had earnings that were digested favorably, has moved up to a very important level for it with the 50-day moving average hanging overhead here. This could simply be a pause in this new uptrend. It could also be an absolute rejection spot from a technical analysis standpoint. But I'll just remind us once more, if we're taking the longer term viewpoint here, we're probably not looking to be exiting a position a week or 2 weeks after having put the position on. Now, a trader who picked this up a week ago at 22 and is staring at $2 of profit could easily say, yeah, I'd like to take a little bit of profit thanks to the move. But that's a different philosophy as it relates to the process, right? Long run versus short term, very big difference there. And what I'll invite and encourage you all to give consideration to is the idea that if I bought it with the sole purpose of owning it for the next 10 to 15 years or more, well, then these moves are rather irrelevant in the long scheme, right? The process that matters to the long-term investor is not necessarily taking profits when given the chance. It might just be making certain that you have the proper portion of your money devoted to these individual groups, okay? And by the way, in terms of healthcare, when considering the MSCI allocation model, healthcare falls at about 11% of a portfolio, whereas technology comes in right around 23%. So just to give you some idea as to percentage-wise what some investors might be working towards. All right, so there's our healthcare. Let's quickly peek in on Berkshire B. If I want to make that trade, make that all work out the way that I'd like to, I'm going to have to add in my send to here as well. So we'll move that up. And let's look at Berkshire, and then we'll check out JP Morgan as well. So Berkshire Hathaway still in an uptrend. For those of you wondering about defining such things, it can be as simple as looking at the lower left. Did we start in the lower left, or did we go from the lower left to the upper right, which is what we've seen here, right? Here's our initial beginning for the chart. Here's a higher low. Here's the next higher low, next higher low. And then we had a lot of higher lows in here, didn't we, when we ran from here through here. Now we've been in a bit of a price discovery and figure things out again. The intriguing thing is we got ourselves right back up above the 50-day moving average here in purple, and we're just wondering about a potential for a breakout. We haven't seen it. You can see up here, if you're looking at this price action, you'd say, well, there does appear to be a bit of a ceiling on price action at around 530 to 535, doesn't it? Yes, we've had a high close close to 539, but look at all of these tails. And what do these tails mean, everybody? It's a reversal of price action, or rather it's a come to the price level range and realize that supply is greatly outweighing demand at that range of price. And that's what pushes these price sticks lower. The candlesticks are pushed back from here because every time buyers are trying to continue to purchase up, what happens between 530 and 535 is there's just an insufficient amount of volume to keep pushing price higher. And that's because all of the sell volume keeps basically chewing up all the buys. So every time that there's someone interested in buying, there's more than enough sell side shares to take on all that purchasing, and price just can't rise. So it's a true point of equilibrium here. What's very important to know as it relates to the potential of resistance at this level is that a breakthrough this level would very much be important, right? Because we've so consistently for all of 6 weeks now basically banged our heads on this ceiling. Well, eventually, the ceiling and the drywall, the sheetrock gets worn down at some point, and you would perhaps expect to push right on through. Well, if and when that happens, then we have an opportunity for more upside. Now, in our purpose here today with Berkshire B and our desire to simply have allocation to financials, we don't need to make an adjustment to this one. Let's jump back to that monitor tab. How about JP Morgan? We'll take a quick peek. And this looks intriguing for some traders because we've got off the mat down here at 203, 204, and we are 40 points up. Not only are we 40 points up, everybody, we have managed to move through some of those important levels, right? Not only move through them, let's go back and talk a little bit of technicals on this once more. We broke the downtrend right through here and held So now you're looking at 1, 2, 3, 4, 5, 6, 7 sessions in a row holding the breakout level, everybody. So with that in mind, if a trader were saying, I've been waiting for a reason to put money to work in JP Morgan, you could look at the last week and a half as some validation of a new price level being achieved. If you're trading, you might choose to stick with it as long as it holds on to about that 237 level. Doesn't make a new low, rather does not close below the lows we've made in the last 7 days. Some traders would tell you that's a way to look at it. But from an investment standpoint, they might say, yeah, we broke the downtrend here, and now they're expecting maybe a slow move back to where we have previously been. So the fact that we've broken the downtrend, held the breakout level, is going to give bullish investors, as it relates to JP Morgan here, a little bit of confidence. So if I was looking at this today and saying I'm in need of devoting more dollars to JP Morgan here, then this chart would perhaps validate that approach for the investor. Having broken the downtrend, having held the 50-day moving average, closed above it 3 days in a row, look like today will be day 3. There's certainly sufficient evidence for bulls to maybe add to a winning position. Yet again, we're not going to make that adjustment to our example portfolio here, but we are going to just make note of it. That's a nice development in the chart of JP Morgan here. We'll see if that carries. Okay, back to that monitor tab. We've gone through healthcare, we've gone through financials. You know what? We're not going to have terrible time looking at those technology, because technology has bounced so nicely here in the last week and a half. So our returns as it relates to tech have been fantastic, but I'll remind you, we're not going to look to make too many adjustments here. But what could we see? We've got a bit of a former downtrend here in Adobe. It has certainly recaptured a short-term level here with the 20-day moving average. And if we wanted to be looking to devote more money here, you might be looking for a more significant shift in the true trend. And I say that because what we're seeing here is still pretty far below the long-range 200-day moving average. The odds are perhaps in favor of us getting somewhere to this area, right around 466. You could get that kind of a move and still be in a downtrend, right? So that's really tough to sustain. Some traders might choose to take a chance on Adobe as it could push to 465, 466, maybe the 200-day moving average there, but they're probably only going to do that if it can get above that 50-day moving average for a defined period of time, something that makes sense to the investor. Right now, it's a little still questionable. We've continually made gaps and lowers, so it's lower highs and lower lows. Our exposure is fine to the group. We're happy to have a little bit of profit in the short term, but you know what? We're going to ask that we see a bit more out of Adobe before adding to it here, because the possibility surely exists that we could continue to rally into the 50-day moving average, say 385, 390, and we could get rejected there. You know what? I'm fine with that. I want to devote more money to other areas of the market instead of overdoing technology. Now, certainly things have improved from the standpoint of price action for the technology space, for the sector of technology, and things like the NASDAQ 100 as an example. Those things have improved over the last couple of weeks. However, our concern is that we've improved, but we haven't seen improvement in the underlying data necessarily. So it's certainly fine to be cautious on such a move here. And again, downtrend. Sure, we like the fact that we've got some shares and we've got that exposure, but there's no need to overdo our process here. It's far more important to stick to one's existing long-term plan. Try not to make decisions that alter your long-term investment plan that are based on what happens in the market in the short term. That's a really important point, so I'll state it the second time. Don't make decisions to your long-term plan as to how you like to put that money to work, how you're going to invest it. You don't want to make decisions on that or make changes to that plan based on short-term market fluctuations. Make decisions like that based on your personal scenarios. Are you getting married? Are you having kids? Are you set for retirement? Those are the individual windows of time where you want to be making changes to your long-term plan. Don't let the market dictate that for you. All right. Hopefully that helps. Okay, let's keep it moving, everybody. Many of you are asking really appropriate questions about viability as it relates to these underlying stocks. And I'm not here to tell you that they are or they are not. I'm not going to be able to speak to the fundamental details of these companies or the health of their balance sheets. That's not the aspect of today's class. What we're working on here is simply devoting money to individual groups, trying to simply take advantage of weak markets to provide entry for short positions. And what I mean is short, like small size positions that'll get us started in some of these investments and give us an opportunity to have exposure to these categories. And again, from an investment standpoint, doing so at levels that are depressed historically is proven out to be favorable in a longer term viewpoint. That's all we're stating here. So please recognize that everything we do within our example portfolio is just that, an example, but not a recommendation in any way. Okay, next up there we have in the monitor, we got NVIDIA. So a quick peek on NVIDIA will show that today, finally, NVIDIA tested the 50-day moving average. We haven't seen that since February 24, I think. Oh, the 27th. We opened above it, and we got absolutely smacked back there, unfortunately. 134 all the way down to about 86, 87. Yeesh, that was a pretty rough move. Well, we finally have gotten back to the 50-day, and now the question becomes, can NVIDIA hold the 50-day? Once more, we're not worried about is it going to maintain it? Are we looking to take profits? No, we are not. If the 50-day were maintained, some investors would start to put some more money into NVIDIA by virtue of its potential to make a change to the trend. You've got a couple of different ways to look at that trend. Yes, you have a downtrend off of this peak, but if we also drew this line through the most recent lows, oops, I'm going to draw that actually right about through, well, basically through here, right? I mean, some traders would tell you that we've already broken perhaps the most important aspect, which is these lower highs in here. So if this holds today and we get some continuation tomorrow, that could absolutely improve for NVIDIA. But once more, we will not make an alteration or an adjustment to our position. And then lastly, we've got that First Energy there. Don't expect to make a change to First Energy either, but we are going to look at some opportunities for our next investments, everybody. So we'll take a quick look here at FE on the chart. We've got a small amount of money devoted there, and everything that we've seen out of FE is still valid for the long side of our long-term portfolio. We don't see any concerns here. For owning it, maintaining our existing position. We've recently broken higher, and you've got a little bit of a bull flag that has tried to resolve bullishly over the last couple of days, trying to get a close over 43. Looks like that would be a really nice development if it could get it, everybody, to close over this 43 level. It's only done it once, and that was 2 days ago, and then it just couldn't really hold. So keep an eye on that. That's a possibility for a continuation move to the upside. But once more, the technicals on a day-to-day basis are not terribly important for those of us building long-term portfolios. They can be instructive and they can be helpful, but not terribly important. Now, we are going to take a look at bringing some consumer staple stocks into our portfolio today. So we are going to go back to my scan tool, which I have detached. And everybody, all I've done here, very basic stuff. I've gone ahead and scanned within the S&P 500 and intersected with staples. I did that by coming down to industry group and went to consumer staples, and I said, show them all. I'm not going to get too niche moved here. I could if I knew that I wanted exposure to one of those industries. Remember, I'm talking about the breakdown of our spaces, right? We've got broad indices like the S&P 500. We have broad indices like the Russell 2000. And all we're saying here is we need some exposure to staples. We could get granular. We're not going to do that at this point. So we'll stay within staples. And then the next thing that could be helpful to investors is looking for some signals of strength, right? So where can we define that strength? Well, we could do so with something like the 21-day relative strength, which will tell us, without telling us return detail, it lets us know where are the leaders in the space relative to the rest of the market. And we've got a few leaders up here, some companies with whom we're probably a bit familiar. You can also do that kind of sort over an 89-day window, closer to about 4 months in length, capturing those few extra days each quarter. And you could certainly do that, but you could also, maybe you decided you need some access to dividend yield. You could also incorporate dividend yield here. But again, I've only done this for the S&P 500, so maybe we need some exposure to this space in small caps, and you could always just say, yeah, instead of scanning within the S&P 500, go ahead and scan in the Russell 2000, and you might choose to do that instead. Okay, so the that process I just wanted to highlight is very easily done. So if you realize I've got only large cap and I need to bring some small cap in, maybe you start to work in the Russell 2000 in lieu of the S&P 500. Let's see here. Andrew, the purple next to this is the number 5 actually, and it's my link that lets me see this in the form of a chart. So I'm going to, let me do this. I'm just going to sling this over here and I'm going to shrink this down so we can still see my symbology. This is just a cheat that I'm going to use, but that 5 puts Walmart on the chart here, right? Now, I know it's there actually. Let me do this. There you go. See the symbol right there, Walmart. And Walmart's making an interesting move because it's broken through a level that previously had been resistance. So maybe this is an opportunity for Walmart that some traders or investors might be looking to add to get exposure to staples. We, in our example portfolio, we do not have any staples at this time. So this is something we're going to need to add to the portfolio. Maybe not Walmart in our example trade, but let's just look at a couple more here. Here's Dollar Tree. Dollar Tree looking kind of intriguing in the sense that it's moving through. Maybe it has created a new base here. This is pretty notable. We're looking at the level having moved through here with a very nice development after breaking the 200-day moving average to the upside. It's held quite nicely in the midst of some excessive or a little bit higher volatility. Volatility has been waning a bit, but this is an interesting development. This looks like an opportunity to try and take advantage of and get some exposure based on the fact that we've moved through a very important level. I mean, look, everyone, we were under this ledge all the way back to the earnings in September of last year. So yeah, you're looking at about a 7-8 month range that has now been broken, and an investor might start to feel a little bit more confident here. So let's go ahead and just pick some of this up. We're not going to do this as a custom buy, so we don't need to concern ourselves with an exit strategy per se, because we're looking at this from the standpoint of just getting our money to work. So the one thing I need to edit is I need to change the amount of shares I'm buying here. And I think for our math, 25 shares ought to be at a sufficient balance to go with here. Instead of a limit, we're just going to change that to market so that we get into it right away, and then it's going to place that in our staples location. So it's about a $2,000 investment there, buying $25 tree at market. Let's go ahead with that. All right, so that got in there into our monitor portfolio. And yeah, see it went ahead and made a brand new consumer staples space right for me there, everybody. So that's because, again, I have it defined right up here. I said, show me groups by sector. So I went ahead and did that, added Dollar Tree right there. And again, if I want that send to button, I've got to add it. So I'll put it right there. All right, let's go ahead and grab one more staples position. We saw Walmart. Let's see, how's Costco looking here, everybody? Costco. Well, see now, remember how Walmart, I drew that line through those highs that we saw like this? Walmart was already through that level. So maybe that makes a little bit more sense than Costco. Let's hold back on Costco here for that reason. It's possible it could pop right through, but maybe it meets a little bit of resistance here. So again, timing might not be all that important for the long-term investor because again, buying at $1,000 a share versus buying it at $1,020 a share, $10 or $20 difference 10 years down the road may not make much of a difference. Ooh, well, that's a notable chart. Yeah, you're absolutely right, Thompson. What a nice move here in Kroger. We've had a 50-day test a couple of different times. Boy, dating all the way back to September of last year, I mean, outside of a couple of small windows here, like one small window right there, that 50-day moving average has been your support line. In fact, if I hid the 20 and put the 50 only with the 200 up there, the blue is the 200, the purple is 50. My goodness, you've had only a 2-week window below the 50-day. And if you chose to get right back in when it recaptured the 50-day, you would have been well rewarded. That is truly a definition of an uptrend. And you know what? I don't see any reason not to consider that for an example portfolio ad. So let's go ahead and pick up some of this. 25 shares of that will be a little less than 2,000. So that makes some sense. We'll go ahead and just do a buy here. We'll edit that, make sure I get my 25 shares. We'll also change that to a market so that we get it in there right away. Yeah, about 1,800. So that ought to fit. All right, there we go. Now we've got exposure there. All right, so now we're looking at about close to 2,000 total in our total position here. Dollar Tree, KR. Oh, these are not, excuse me, these are not the, this is margin requirement. I'm sorry, everybody. That is not the total. I'm needing to see the total market value. So let's see. There we go. Add in total cost. And then that gets it right here. So we need to add total to all of those. So I'm going to do that over time in the next before the next class, everybody get everything added in there. But it should absolutely be incorporating that and looking at our subtotals. And yeah, you're right. It's exactly right, Thompson. Kroger. Why is Kroger showing an uptrend? Because, well, groceries aren't exactly something that we can avoid, right? There may be something to be nervous about down the road if we can't supply groceries, but that's a different story for a different day, most likely. But it's a great point, and it gets us back to examples as to why certain groups work in difficult windows of time. Remember, when we are in the midst of a bull market, the odds are that we are being led by technology space, right? By the technology sector, by large company stock in the S&P 500. But when we go through difficulties in the market, we go through recessions and things like that, we have groups that are not the traditional leaders that come to play, that being staples, healthcare, utilities, and potentially real estate and real estate investment trusts. So a reminder that you can't stay consistent with your process based on, regardless of what the market's doing. I think it's very important as investors and traders alike that we recognize the cycles of the market, and then we position ourselves to, most commonly, not be hampered or hurt by going through one of those weaker cycles. And that doesn't mean that you absolutely should be doing something dramatically different. Sometimes it just means recognizing that we could be going through something that is difficult to deal with. And then you as the investor just need to paint a slightly different picture of the market and further of your expectations for the market, which can also help to kind of mitigate your concerns a little bit. So, all right, everybody, I think we're going to wrap it up right there. We've covered quite a bit today. We talked about the understanding of top-down methodology, working from our broad indices into sectors, into sub-industries, and then into stocks specifically, right? We've scanned 4 groups in Staples to build that portion of our example portfolio today. We've placed a couple of new purchases to make sure that we get that exposure to those spaces. And then we're going to come back and revisit this again. Next week, we will look at the breakdown of these individual positions. We'll see if there's anything we need to make any adjustments to, and further expose more dollars to more areas of the market, because we've only got staples, healthcare, financials, and tech, and other, essentially energy, but we're going to need some components elsewhere, right? We will surely need to get some utilities. We'll need to get a little bit of real estate. So we've got other groups to look for still. Plenty to do in subsequent sessions with all of you. So thanks for being here. Big thanks to Mike Fairborn there in the chat. Follow us on X, Mike Fairborn CS and Kevin Horner CS. And if you like today's discussion, I'd really appreciate a thumbs up button down below. If you smash that for me, that's going to help us out when we get this thing in the archives for all of you. And speaking of those archives, finally, don't forget that link is in the chat near the top. So if you want to have that archive and reference it for later, or have it bookmarked so that you can get to these archive classes as soon as they make it there, it's a good idea as well. So with that, I will wrap it up. Hope you all have a fantastic rest of your Thursday. Thanks for joining us for our inaugural National Investing Day here. It's been a great one. Hope to see you all again real soon.